If you have enough money to buy property in Mexico with cash, should you? Or would you financing part of the purchase be the smarter decision? Paying cash can simplify a transaction and sometimes improve your negotiation position. But using most of your available capital to purchase a property can also leave you financially exposed. Financing allows you to preserve liquidity, but interest, fees, currency risk, and payment obligations might significantly increase the real cost of the property. So the right question is not simply, can I pay cash? It is, which payment strategy best protects my financial position and supports my objective? Today, I will explain the principal ways foreign buyers pay for property in Mexico, the advantages and the risk of each one, and the questions you should answer before deciding. Welcome to the Foreign Buyer's Guide to Mexico, the series created to help foreign buyers understand how real estate transactions work in Mexico and make better informed property decisions. I am Nancy Valiente. I am an attorney, economist, and real estate advisor with more than 13 years of experience representing buyers in Puerto Vallarta and Riviera Nayarit. In episode 9, I explain why sometimes advise a client not to buy. One of those reasons is financial exposure. A buyer might have enough money to complete a purchase and still choose a payment strategy that creates unnecessary risk. That is why the method of payment deserves its own analysis. In real estate, a cash purchase generally means that the buyer does not depend on a mortgage or another loan to complete the transaction. The funds still need to be transferred through the appropriate transaction structure, properly documented and available according to the closing schedule. Cash purchases have clear advantages. They can be simpler because the transaction is not subject to loan approval, appraisal requirements, or a lender's closing conditions. They can also be faster, although the legal process in Mexico, including due diligence, the notarial process, and the establishment of a fideicomiso, when applicable, still takes time. Cash might also strengthen a buyer's offer. A seller could prefer an offer with fewer financing contingencies, particularly when comparing two offers with similar prices. But cash does not automatically mean the buyer should pay the asking price. A strong payment position can sometimes become a negotiating advantage depending on the property, seller, and the market conditions. Most importantly, paying cash does not reduce the need to investigate the property. A cash buyer still needs to review title, liens, condominium obligations, taxes, physical condition, documentation, and the seller's authority to complete the transaction. Paying faster does not make an unverified property safer. The greatest risk of a cash purchase is not necessarily the transaction itself. It is what happens to the buyer's financial position afterward. Imagine that someone has available $400,000 available and purchases a property for $350,000. That person might still need to pay closing costs, furnish the property, complete repairs, purchase insurance, and cover ongoing expenses. If almost all the available capital is committed to the purchase, the buyer might become rich but cash poor. That can create pressure when an unexpected medical expense, family obligation, major repair, or change in income occurs. For that reason, I do not evaluate a cash purchase only by asking whether the buyer has enough money to close. I also ask how much liquidity will remain after closing. What other financial obligations does the buyer have? Will the property require additional capital? And how stable is the buyer's future income? A property should support the buyer's life, not consume every available financial resource. In pre-construction, buyers are often offered a payment plan directly by the developer. This is not always the same as traditional financing. A common structure might require an initial deposit, several payments during construction, and a final balance at delivery. The advantage is that the buyer can distribute payments over time without immediately transferring the entire purchase price. In some cases, the plan might be interest-free during construction. In others, the price or terms might change depending on the payment schedule. The important issue is not whether the monthly or quarterly payments appear manageable. The buyer must understand the complete schedule. Pay special attention to the final payment. A plan can look comfortable during construction, but require a very large percentage at delivery. If the buyer expects to obtain financing later, sell another asset, or receive future income, that assumption should be examined carefully. What happens if the expected funds are not available? Can the buyer obtain financing at that time? What does the contract say about late payments or buyer default? Could the developer cancel the contract and retain part of the money already paid? A payment plan is only helpful when the buyer understands and can realistically satisfy every payment, not just the first one. Developers might offer different prices depending on how quickly the buyer pays. For example, a larger initial payment or an accelerated schedule might receive a discount, while a longer schedule might have a higher total price. The discount can be attractive, but it should not be evaluated in isolation. A buyer should compare the amount of the discount, the initial capital that must be committed early, the protection provided by the contract, the construction and the delivery risk, and the financial value of preserving that money for another purpose. Paying early might reduce the price, but it can also increase the amount of capital exposed before the property is completed. The largest discount is not automatically the best financial decision. If this information is helping you understand the financial decisions involved in buying property in Mexico, subscribe and watch the complete Foreign Buyer's Guide to Mexico playlist. Buying successfully involves more than finding the property. It requires understanding the legal, financial, and practical consequences of the transaction. Some foreign buyers might qualify for mortgage financing through a Mexican financial institution or a specialized lender. Availability and terms depend on the buyer, lender, property, and transaction. A mortgage can allow the buyer to preserve capital and distribute the cost over a longer period. However, buyers must examine more than the advertised interest rate. The complete cost might include interest, origination or arrangement fees, appraisal expenses, insurance, closing-related charges, currency conversion, and possible early payment conditions. The lender might require financial documentation, an appraisal, approval of the property, and additional conditions before closing. That means an offer depends on financing should clearly address that dependency. A buyer should not present a transaction as cash and later assume that financing will be available. The contract and deadlines must reflect the actual payment strategy. Some buyers consider using a home equity line, investment-backed loan, or another source of financing in the United States or Canada. From the seller's perspective, the Mexican purchase might still appear to be a cash transaction because the buyer brings the required funds to closing. But from the buyer's perspective, it is a finance purchase. This distinction matters. The debt might be secured by another property or investment account outside Mexico. Therefore, the buyer is not only evaluating the Mexican property, the buyer is also placing another part of their financial life at risk. Before choosing this strategy, the buyer should understand the interest structure, repayment obligations, tax considerations, and consequences if assets values or income change. These questions require advice from qualified financial and tax professionals in the relevant jurisdictions. Currency deserves special attention. A buyer might earn and hold money in the US or Canadian dollars while the purchase price or payment obligations are established in Mexican pesos or the reverse. Exchange rate movements can change the real cost of future payments. A payment that appears affordable today might cost more in the buyer's home currency when it becomes due. The contract should clearly identify the currency of the purchase price, the currency in which payments must be made, the exchange rate mechanism if one applies, and who bears the cost of conversion and transfer fees. Which currency controls the obligation? Currency risk becomes more important when payments extend over many years or months. When helping a buyer evaluate these alternatives, I consider 5 questions. First, what is the total cost? Not only the price, but interest, fees, exchange cost, and any difference caused by the payment plan. Second, how much liquidity remains? The buyer needs enough capital for closing, ownership expenses, and unexpected events. Third, what risk is being accepted? That might include interest rate risk, currency risk, construction risk, or the risk of pledging another asset. Fourth, how reliable is the buyer's future source of payment? A strategy dependent on uncertain income, a future sale, or unapproved financing requires particular caution. Fifth, what is the buyer's objective? A retirement buyer, a rental investor, and someone purchasing a vacation home might reasonably make different decisions. Consider 2 buyers purchasing the same property. Buyer 1 has substantial liquid assets, stable income, and enough reserves after closing. Paying cash might simplify the transaction and eliminate financing expenses. Buyer 2 could technically pay cash, but doing so would use nearly all available capital. The buyer might be better served by financing part of the purchase or selecting a less expensive property. Now, consider buyer 3. This buyer chooses a developer payment plan because the initial payments are manageable. However, 50% of the price is due at delivery, and the buyer has no confirmed source for that money. The property might be affordable today, but not affordable when the largest obligation arrives. The same property and payment plan can be reasonable for one buyer and dangerous for another. I do not believe cash is always better. I also do not believe financing is automatically more sophisticated because it preserves capital. Debt only creates an advantage when the cost and risk of that debt are justified by what the buyer does with the remaining liquidity. The correct decision depends on the complete financial position, not on a general rule. Before signing, buyers should know the total amount they will pay, every payment date, the source of each payment, the currency controlling the obligation, the consequences of late payment or default, and the amount of liquidity that will remain after closing. If you are comparing properties or payment plans in Puerto Vallarta or Riviera Nayarit, do not evaluate only the purchase price or initial deposit. Examine the complete transaction and how it affects your financial position before, during, and after closing. If you would like a strategic guidance based on your objectives, you can find my contact information in the description below. Subscribe and watch the complete Foreign Buyer's Guide to Mexico playlist. I am Nancy Valiente, and I will see you in the next episode.